President Donald Trump signed the One Big Beautiful Bill tax legislation on July 4th, 2025. We're going to provide an overview and analysis of the 2025 tax reconciliation legislation. We'll explore how the new law preserves key provisions of the Tax Cuts and Jobs Act, delivers trillions in tax cuts, and introduces a range of significant changes and tax increases, analyzing the implication for corporations, pass-through entities, tax-exempt organizations, and individuals. I'm Amy Kottman, and you're listening to Baker Hosts. Today we'll hear from the Honorable Peter Roskam, Federal Policy Team Leader, and Jeff Paravano, Tax Group Chair at Baker Hostetler. Let's listen in.
Thank you for taking the time to join us. My name is Jeff Paravano. I serve as Tax Group Chair at Baker Hostetler and Managing Partner of the DC office. I previously served in the Department of Treasury's Office of Tax Policy. We're incredibly fortunate to have with us today former Congressman Peter Roskam, who leads our federal policy team. Peter spent 12 years in Congress and chaired 3 subcommittees of the House Ways and Means Committee, among other impressive things. But one of the things Peter did was chair the tax policy subcommittee of the Ways and Means Committee, and he was one of the primary architects of the 2017 Tax Cuts and Jobs Act. He's been incredibly active with his team with this most recent bill. He's been on the Hill day after day, over and over again. And frankly, there's still a fair amount of work to do, both with regulatory and administrative implementation of these provisions. We need a lot of this stuff to be fleshed out. And then also with respect to additional bills, both normal course legislation and perhaps up to 2 additional reconciliation bills. So with that, Peter, let me turn it over to you.
Thanks, Jeff. And I think, like a lot of people, you and I and others and other folks, it's this sense of, oh, this bill is finally done. And I just want to take a step back and begin to think about how is it that this bill came to be? And it's a process that it's called budget reconciliation. And the seeds of this were planted when the Republican Party took the majority in both the House and the Senate and the White House, which creates a vehicle that allows the Senate to do an end run around the filibuster. So it's, as we know, it sounds easy, but it's not an easy thing to accomplish. And my experience in interacting with a lot of tax practitioners over the years is that sometimes they'll look at policymakers and say, how is it that this thing came to be? Couldn't this be more, quote, sensible, or couldn't this be more coherent and comprehensive? And how is it that seemingly incongruous pieces end up coming together? And the answer is to look at the politics of this. And so we've seen a process over the past several months that we've all been watching and in many cases actively participating in, various versions of this bill lurching, moving forward, coming back. And it's all in the quest to find 218 members of the House and 50 plus 1 members of the Senate, and something that can get to the president's desk. So what is one of the takeaways is that the breadth and scope and depth of this bill. In other words, it has an impact, Jeff, on every bit of the U.S. economy, and by implication, every bit of the global economy. And so there's no part of the American economy that is not touched by this legislation. And it is also, I think, a story that is unfinished in many ways. And what do I mean by that? The bill has been signed, it's now been enacted, and isn't that the end of the story? No, because the attention now turns to the administration in the promulgation of these rules, and the Treasury Department is under enormous pressure now to interpret the new things where rulemaking is necessary. And if TCJA is any guide, and I think it should be, that is a process that takes a lot of time. And Treasury is going to be, while they're under enormous pressure, they still have a process that they need to work through, and that's an arduous process. And you will have various elements of the economy vying for attention of the Treasury Department. It's important that you do this first, and here's why, and so forth. And so you take my point that there's enormous pressure. The other thing to keep an eye on, and it's a little bit tough to track, is, well, and there's been reporting on this that said certain members of Congress were given assurances by certain members of the administration about how some of these things were going to be dealt with. And it's very difficult to get a straight answer on that, but I will come back to this underlying notion that when it all comes down to it, Treasury Department is limited, the administration is limited to the plain language of the statute. And so that will be a parameter that will come up later in our discussions as we move through some of these other provisions. Jeff, let me make one final point before we get to these main takeaways. And that is, there's been discussion of the possibility of a new reconciliation bill, not a new one, but a second reconciliation bill. And that's an open question right now. What's the GOP's appetite to use that vehicle? How would they fashion that? Was that part of the conversation that was made in getting votes for this to pass? And I think most lawmakers that I'm in touch with and that our team is in touch with, and I'm just breathing a sigh of exhaustion, frankly, for having this done. I was teasing one member of Congress and I said, this is the closest thing to birthing a calf as you're ever going to deal with. It was like this arduous process. And now it's the law. So, Jeff, let me yield to you for some of the summary and the highlights. But I think that's some of the atmospherics that are impacting the politics, which impacts the net result.
Thanks, Peter. And we took the over 900-page bill and summarized it and analyzed it into about 30 pages. But one thing I wanted to point out is just the enormous cost of this bill. I remember when I was with the Treasury Department and we did the first Bush tax cut, 1.6 trillion over 10 years. The net cost of this bill is 4.5 trillion, spending cuts of 1.2 trillion for a cost compared to current law of 3.3 trillion over 10 years. But that doesn't begin to tell the story, because when you look at the net tax cuts of 4.5 trillion and you dig into that, you'll see that there's actually 12.5 trillion of tax provisions. There's increases and there's decreases. There's never been a bill that's been this enormous as far as size and have so many increases and so many cuts. It affects nearly every sector of the economy, every type of taxpayer. Any thoughts about just the enormity of it all before we go into the details, Peter?
Look, I think it's a reflection of two things. Number one, the economy is much bigger now, so that's part of it. And also the aspirations of President Trump are bigger. They, rather than piecemealing this or breaking this down, there's the aptly named One Big Beautiful Bill. It is a massive piece of work. And I think there were a lot of dials that were adjusted. And some of this was in the base text coming in at the House, and then the Senate had a few things to say, as we know, and the House ultimately adopted all of those Senate changes.
One of the more welcome things is that the Senate makes most of the provisions permanent that were often part of an extenders package. And I remember when I was with the Treasury Department, we would often extend things, and then we would often pay for that by putting permanent things into the code. So you might recall that the Democrats put in a 1% excise tax on stock buybacks to pay for some temporary extensions of some things. They put in a corporate alternative minimum tax on a permanent basis to pay for some extensions of some things. So it's refreshing, I think, that a lot of these corporate provisions in particular and other things that were extended over and over again, including with often permanent pay-fors, are now permanent themselves. And Peter, you want to comment a little bit on how the Senate got to a point where they just said, look, permanence on most of these things or
This
nothing?
became a hill to die on for some members, some influential members of the Senate Finance Committee. I know Senator Daines from Montana made this a real priority. He was out front, he was articulate, he was public, and he wasn't alone, but he built up a constituency early in the Senate that said this has to, what some people over the years have referred to as the extender circus. That is this kind of ridiculous way of having tax policy that is episodic and unpredictable, that they had enough of that. And so I give a lot of credit to Senator Daines and his colleagues for saying, we're not going to be complicit in this, and this is a real priority. And they were successful in driving that.
One of the points they made over and over again is, look, if you want GDP growth, you need certainty. People can adjust to a little higher rates, a little lower rates, but if the rates are constantly changing and they're trying to make investment decisions and they don't know what their return's going to be, then in some cases, they're just going to stay on the sidelines and not make those investments. So I think there's a real quest to foster GDP growth with some of these permanent changes. Now, at the same time, they're floating all these tariff ideas and implementing those and not implementing those. And that's created a lot of uncertainty. That uncertainty, I think, has caused a lot of acquisitions and in the M&A pipeline, people to pause. You don't want to, if you're a private equity company or you're a public company that routinely has an acquisition pipeline and does deals, number of deals on a regular basis each year. If you're about to make a purchase and you don't know about the supply chain costs, you don't know about the costs of raw materials, you may be sitting it out. And I think a lot of folks are. We've gotten assurances from the Treasury Department and the Commerce Department and others that this is really going to settle down very significantly by the end of August, and that starting in September, people should have a pretty good idea of what tariffs are in place, what tariffs aren't in place, what costs are higher, what costs aren't, so that investments and in that space can continue. Peter, any thoughts about that?
I think it's interesting. So there's been an extension of deadlines by the administration this week, which I think is communicating they're looking to get to yes on some of these deals, and they see the value of them. And then Jeff, to put an emphasis on the point that you made, I interact with so many people, and I know so do you, who will communicate, look, uncertainty is actually worse than bad news. Give me bad news, and I don't like the bad news, but I can deal with it. I can come up with a plan. I can price it. I can go to the market. I know what I'm dealing with. But if things are uncertain, it has the impact, it's paralyzing. And so I think getting back to the tax code element of it, that was one of the reasons that the senators in particular really put an emphasis on it, to have an underlying foundation that was solid, and then people could move forward and ultimately make investment decisions.
Great. Before we get into the details of what's in the bill, let's talk about a couple things that didn't make it into the bill and a couple things, more than a couple things, that were dropped from the legislation with a lot of work by Peter and others. I remember some emails where your response was, good grief. Some people were, their hair was on fire and they were screaming, and your response was just, good grief. We'll communicate with them about this and explain why it's such a bad idea. So let's start with things that didn't really make it into the bill. There's no changes to carried interest. There's no changes to the corporate tax rate. There's no changes to the capital gains tax rates. It did not reduce the corporate rate for U.S. manufacturing. Remember, the president talked about a 15% rate for U.S. manufacturing. I think it just became impossible to write that down and figure it out and figure out how to make it work. But it does allow full and immediate expensing of certain manufacturing facilities, including 39-year property. So that was thrown in to help promote onshoring and help promote U.S. manufacturing, since they couldn't go to the 15% rate. It does not repeal the stock buyback tax. A lot of Republicans hated that. It was put in during the Biden administration. They wanted to get it out before it's dialed up in later years, but there just wasn't the space in the bill to do it. It doesn't repeal the corporate AMT. Terrible idea. Just look at the reg package and how complicated it is and how few corporations it applies to. Should have been pulled, but there just wasn't room to do it. It doesn't contain any limitations on corporate deductions of state or local taxes. They talked about that. And then, unlike certain earlier drafts, and there were numerous drafts, there was the Ways and Means draft, there was the House draft, there was an amendment later to that draft, and then there were also 3 drafts in the Senate. It became a little confusing at times as we were trying to keep everything in order and what they were doing and what they weren't. And there was also a very last minute change in the Senate, a manager's amendment. And then there was an attempt to amend it further, and none of those were successful. But let's talk about some of the things that were dropped. Probably most importantly, it dropped the proposed Section 899 revenge tax that really could have interfered with investment by those not based in the U.S. into the U.S. It dropped the proposed attack on pass-through entity SALT deduction workarounds. I think we can thank the AICPA and the investment advisors and maybe even some of the lawyers and ABA for saying to the Senate, look, if you want to raise taxes on the highest earners by 2.5% or more, just do it. If you do it in the context of purporting to raise the cap on SALT workarounds from 10 to 40, And by the way, none of those high wage earners get the benefit of that because it phases out for earnings over $500,000. But in that context, go after the workarounds and actually increase taxes on many high wage earners. It's just not a good way to do it. It might be fair, as some might say, to get rid of the workarounds, but it's such a significant tax increase and it's such a change in policy from what's been going on in recent years. It's hard to do it in a situation where you're purporting to raise the cap when you're actually raising very significantly taxes on the highest wage earners. So those arguments were effective and it was dropped this time around. I would say we need to continue to be vigilant because there's a lot of thoughts about those workarounds and there's more reconciliation bills, probably at least 2 more in the next 12 months or so. It dropped the proposed 41% punitive tax on litigation funding. It dropped the proposed excise tax on wind and solar projects that receive certain assistance from foreign entities of concern. It dropped the proposed moratorium on states regulating artificial intelligence. There were a lot of questions about AI and porn and revenge porn that the states have taken the lead on regulating. There was something out of Tennessee with Elvis and Elvis impersonators using AI and regulation by that state. And I think the Senate just decided, look, this isn't ready for prime time. There's certain state regulations out there that are important, and the federal set isn't ready to go forward. Let's pull it out. And they did it 99-1, Peter. Any thoughts about that one?
It's just interesting how things like that can reach a crescendo, and there's the Senate can move very quickly and say, oh yeah, listen, let's just do that and turn the page. Jeff, I'd like to go back to Section 899 because I think it's an interesting story, because that language was in the text for quite a long time and it got a lot of attention. And we know that a lot of members of Congress were really scandalized at the idea, and this is based on my conversations with them, that anyone could at any point characterize the United States as a tax haven, because that's really the subtext of 899, that there's some sort of tax hustle going on that was insincere, and 899 sought to remedy that. And I think it's interesting that the G7 said, okay, look, we're seeing what's going on. Come, let us reason together. And it's the story of global interest in watching this debate happen and then have an impact on other countries. And I think it had an impact on Canada and the G7. And I think it's a success story in that these large economies are listening to one another in a way that is influential and impactful. So I was glad to see that the Europeans backed off, because you and I were hearing from a lot of clients that were really concerned about 899.
Yeah, you had the Secretary of Treasury, Janet Yellen, going around the world saying, let's form a tax cartel, basically, something that would be illegal if you were not governments. But they said, look, we don't want there to be tax competition. We don't want there to be low taxes, lower than a certain amount. Why don't we all agree that we'll all raise our taxes, corporate taxes, to a certain minimum level? And if certain countries don't, then we'll have top-up taxes so that if there's operations in our country, we can apply a top-up tax to wipe out the benefits of operating in havens. And basically, it was something that was an idea that came from the U.S. It was a terrible idea because I think the U.S. should favor tax competition. They jumped on it, and then they jumped on it and put it together in a way that there was no way that the U.S. system would ever really get there. There's too much back and forth in our Congress to ever get to a position where some countries like the EU could be bullied into doing this minimum tax. So that was Pillar 2. And Pillar 2, which the U.S. kicked off and suggested would be a great idea, turned into something that was really threatening to U.S. companies that didn't want to do country by country under GILTI and things like that. And Trump basically stepped in and said, look, the U.S. is not a tax haven. We tax our companies plenty. And if you're going to threaten us or tell us what our laws have to be or how we have to tax our countries or companies or what benefits can be exempt and what aren't, and we don't have a VAT, by the way, he said, look, we'll just do the 899 revenge tax. And then if a country does that to us, if they do a top-up tax, or if they have a DST, maybe we'll just have increased withholding or other punitive measures against those foreign investors. The foreign investors, that's one of the cases where their hair was just on fire. And rightly, they're not the ones trying to tax U.S. companies, right? They're just trying to invest in the U.S. and make money. And literally, so many CEOs from Germany, Switzerland, and Canada came in and met with senators and said, look, we're basically stopping our investment pipeline because we need to know what our earnings are going to be in the US, and we can't control what our government does. So basically, the State Department, Trump and others went and talked to the G7 and said, look, if you'll agree to get us out of Pillar 2 and work in good faith and say that the US tax system isn't taxes our companies enough and we don't have to do country by country, we'll drop it. And they did. The G7 came out and they did their kind of vague statement, said we'll do it. And then there had been changes already that took the digital sales tax out of the withholding piece of the penalty. But then Trump said, look, I can use tariffs too. So if Canada, which has had a DST for a while, but it hasn't really been effective, and the first payment was due at the end of June, and they said they were going to move forward, he said, look, then we just won't talk about tariff negotiations and we'll keep high tariffs in place, and Canada backed down. Now, interestingly, we had a lot of clients that paid that DST because it was due June 30th, and Canada didn't really say that they would back down until close to that date. And Canada Revenue has said they can't really refund until they have legislation. They're going to come back in September after their summer break and put this into legislation and then give the DST refunds to taxpayers at that point. But what an interesting piece of this bill all of that was, right? Probably one of the more interesting pieces. Hopefully it's settled down. We still have these tariff issues. They're still causing uncertainty. But I said we've got assurances that by September, there'll be much more certainty than uncertainty in the tariff space. Anything else to say on any of that, Peter?
Nope.
Okay. Other things that were dropped proposals relating to sales of public lands, dropped proposed amendments to 7213 to increase criminal penalties in cases of unauthorized disclosure of certain private tax return information. And then, of course, Public Law 86272, which would try to prevent states from taxing companies who merely have website access. That didn't make it in either for various reasons, including probably that it didn't comply with the Byrd Rule. Okay, let's talk about the three pieces of depreciation. So they didn't lower the U.S. manufacturing rate or the corporate rate on manufacturing profits to 15% because they couldn't figure out really how to do it. But they did offer very significant bonus depreciation and other depreciation that is meant to help U.S. manufacturers and others and to encourage onshoring. So the first thing they did is they permanently extend and modified 168 to give first-year bonus depreciation, generally allowing 100% depreciation in the first year for certain property acquired and placed in service after January 19th, 2025. So Trump said, starting on Inauguration Day, you're going to be able to write off, and this is the bonus depreciation piece. There's also expensing for qualified production property. So if you're building a factory or manufacturing facility, including 39-year property, now you've got to do a cost seg, and you can't, there's the office piece doesn't count, but the manufacturing facility piece does. So you can immediately write off 100% of qualified production property, including 39-year property that would otherwise be 39-year. Now there's caveats and effective dates and things like that. And if it doesn't stay as manufacturing property, there's issues, but I'll just say it's for construction of property that has to begin after January 20th, 2025. So we've got a lot of clients scrambling on that and what they could say about that. And before January 1st, 2029, the property must be placed in service after date of enactment and before January 1st, 2031. But lots of interest in this one, and there's a fair amount of complexity associated with it too. The other one is the legislation allows for immediate expensing under Section 179. It upped the cost of qualifying property up to $2 million with a phase out that begins when costs exceed $4 million. That's for property placed in service after December 31st, 2024. That changes current law, which was up to $1 million could be expensed, and the phase out threshold was $2.5 million. R&D, really important for a lot of our clients. Since 2022, taxpayers have been required to capitalize and amortize U.S.-based research and experimental expenditures over a 5-year period, and of course, 15-year for non-U.S. based. The legislation permanently, and this is one that was always part of an extenders package, permanently suspends the capitalization of domestic research and experimental expenditures for amounts paid or incurred in taxable years beginning after December 31st, 2024. A number of our clients got used to capitalizing and they saw that they got a pretty big FDII benefit. FDII is a permanent benefit and they had a lower effective tax rate. So as much as a lot of companies don't like loaning money to the federal government, which is the economic effect of what happens when you have to capitalize and deduct over time, because FDII is permanent and R&D capitalization is merely timing. A number of our clients asked us several years ago, if they ever put this back, could you make it elective so that if we want to capitalize, we can continue to do that? And several years ago, staff said, fine, if the people want that election, they can have it. And that's part of this bill as well. Business interest deductibility, reading the bill, this one was a little hard to find. You had to look in several sections, but 163J, which generally limits the amounts of business interest that a taxpayer can deduct to a number of factors, including adjusted taxable income. That went from EBITDA and then became EBIT without the DA. This legislation puts back the DA, and this time on a permanent basis. And there's some other rules as well, but given the time, I think we'll keep going. FDII, renamed FDDEI, which I think people are still going to call it FDII, but they made a number of changes there, basically turning the effective rate into 14%. And I'm not going to go through the details because there's just so much we have to cover, but it's effective for tax years beginning after December 31st, 2025. It does make these benefits permanent, does prevent the change and the increase in the FDII rate, although it does modestly increase the overall rate relative to the original House version, et cetera. There are some changes. It eliminates the ability to claim FDII benefits on any disposals of intellectual property or other valuable assets to foreign affiliates. It's got a pretty immediate effective date there for dispositions after June 16th, 2025. Moving on to BEAT, the legislation repeals the scheduled BEAT increase that was set to go forward and instead permanently adopts a slightly higher 10.5 rate that applies for tax years beginning after December 31st, 2025. Thankfully, I was at an event with clients recently where these super BEAT provisions were proposed. Those were not included. That would have increased the rate to 14%, would have made the provision applicable to more taxpayers. That was included in the Senate's original draft and some parts of the House. So luckily, no super BEAT. GILTI, also renamed net CFC tested income. This legislation permanently modifies the GILTI deduction rate to 40%, thereby making GILTI's effective rate 12.6% generally. It also permanently reduces the GILTI haircut on deemed paid foreign taxes from 20 to 10, with the result that the GILTI-related earnings that bear a 14% effective rate of foreign tax shouldn't be subject to the residual federal income tax. And it eliminates the QBI-related tax-free return that taxpayers had enjoyed following the TCJA, and it modifies the relevant foreign tax credit limitation provision so that various expenses are allocated and apportioned to U.S. source income rather than to income that otherwise belongs in the GILTI basket. As with FDII, the legislation operates to modestly increase the overall applicable GILTI relative to the original House version, but I think overall it's favorable, and these changes are effective for tax years beginning after 12/31/2025. We talked a lot about Pillar 1, the digital sales tax parts of that, Pillar 2, the top-up taxes, and that foreign countries were doing the revenge tax. So I'm going to, in the G7 announcement and Canada changing their GST, I am going to mention that they reinstated 958B4, which deals with downward attributions of stock ownership in the context of determining which corporations were CFCs. But it does it prospectively only, and with a new 951B that targets its implementation, again, only prospectively. After the Tax Cuts and Jobs Act repealed 958B4, there were lots of thoughts about should it be put back, should it not. There were lots of companies that cared whether it was back or not. There were winners and losers. There were proposals to put it back or not put it back in many bills. I've got a whole page summarizing the discussions and proposals relating to this. But ultimately, it's prospective only, and it's changed and takes care of some of the winners and losers issues. But just a really interesting to watch since the repeal that this so much later is finally back, but back in a very changed way and prospectively only. Some of our clients care a lot about that one. Other international changes, it makes permanent the look-through rule under 954C6, the CFC look-through rule. I'm going to skip some of this. Let's talk about renewable energy provisions in the Inflation Reduction Act. The legislation significantly modifies and in some instances repeals various renewable energy credits that were enacted as part of the Inflation Reduction Act. The changes generate an enormous amount of revenue. Modifications include the adoption of prohibited foreign entity rules that prevent certain entities that either are owned or have commercial ties with persons from covered nations like China, North Korea, Russia, and Iran from claiming renewable energy credits. Modifications adopt material assistance rules that prevent eligibility for certain credits where a prohibited foreign entity materially assists with manufacturing or construction. Lots of people struggling with these issues. These prohibited foreign entity rules take effect in the taxable year beginning after enactment. The material assistance rules apply to facilities, the construction of which begins after December 31st, 2025, and to eligible components produced in the taxable year beginning after the date of enactment. Just ticking through some of the credits, the 45Z clean fuel production credit would be modified to require that feedstocks be produced or grown in the US, Mexico, or Canada. The legislation extends the fuel production credit to December 31st, 2029. 45Y and E, the legislation terminates the clean electricity production credit and the clean electricity investment tax credit for all wind and solar energy property placed in service after December 31st, 2027. There was a last minute change where the termination provision was amended to be effective for property, the construction of which begins 1 year after the enactment of the legislation. So projects that begin construction within the next year are not subject to the December 31st, 2027 placed in service restriction. There is an executive order that was issued by the president. There were some discussions with House members near the end before the bill was passed by the House, where President Trump said, look, I'm going to strictly enforce. And the executive order itself, which came out on July 7th, seems pretty innocuous. It says in Section 3, look, within 45 days of enactment, the Secretary shall take action that's necessary or appropriate or to strictly enforce the termination of the clean energy production and investment tax credits under 45Y and 48E, and then says the Secretary shall take prompt action consistent with law to implement the enhanced foreign entity of concern restrictions. So everyone's looking really at what is the favorable guidance that's out there from the IRS? What's the favorable statutory guidance? What's the regulatory authority or the authority of an agency to make changes to that? What do they have authority to do? What do they have authority not to do? Are they likely to do this? This executive order seemed inevitable after those discussions, but it doesn't really say any much. So lots of people are staying tuned. Some people are not very concerned at all about where this may lead. Other people are envisioning all sorts of worst case scenarios. Peter, any thoughts about that?
I think it's interesting because this comes up in the context, Jeff, of what we were talking about at the top of the presentation. That was, did the administration make certain side deals or accommodations or representations to members of Congress to get them to vote for this final package? And this would have been, some of this was reported. We don't have visibility into this, and it's highly speculative. So you can see that this executive order that you just walked through, it is stating a truism in a way. It's the Secretary shall enforce the law, enforce it strictly, and shall be prompt about it. On the one hand, that's not particularly revelatory. And on the other hand, it's a gesture to some of those. If it does turn out that certain accommodations were made or certain representations were made from who knows who within the administration, it could be that's a gesture or a fig leaf that some of the members who, while they previously criticized the bill, hours later they came out in favor of the bill, and this could be a fig leaf and a gesture for them to use this back in their own constituencies as a laminated hall pass, basically saying, hey, this is the president's coming down heavy on these clean energy credits, and I got this from him. We don't know. It's speculation, but I think that it wouldn't surprise me if that's really part of the story here.
Thank you. I did want to point out 45X did very well. The advanced manufacturing production credit A lot of manufacturing was onshored. There were a lot of Republican House districts that have been enjoying onshoring of production facilities. There's a lot of senators that have enjoyed onshoring and starting and production facilities. There's been a lot of production and that's been moved from China to the US. A lot of US entities said, look, I can't buy it if it's being produced in China. I want to buy it if it's made in the US. So there's been a lot of gearing up of production in the US. There's been a lot of construction of capacity in the US, and 45X did very well, and I think for good reason. It's very consistent with President Trump's desire to onshore and protect US manufacturing and US jobs. Anything to say about that, Peter?
It's a story of lobbying to communicate the value of a tax credit in a Republican constituency. You know what I mean? At first blush, you could look at these and say, oh, there's no way 45X is going to survive in this environment. And yet, when folks went to the Hill, told the story, here's what's happening, here's how we've reshored, it obviously resonated with those policymakers, and it's very effective.
Thanks. Okay, now to the carnage. The legislation did repeal the Section 25E credits for previously owned clean vehicles, the 30D clean vehicle credit, the 45W commercial clean vehicle credit, the 30C alternative fuel refueling property credit, the 25C energy efficient home improvement credit, the 25D residential clean energy credit, Section 45L new energy efficient home credit. There's various effective dates, but they really went hard after residential solar. They went really hard after wind. You'll see that there's a benefit for semiconductor manufacturers. The legislation increases the advanced manufacturing credit, including for semiconductor manufacturers, from 25 to 35. But there was a lot of savings from repealing some of these provisions. All right, moving on to the SALT cap. Basically, when the Tax Cuts and Jobs Act came out, it lowered the effective rate from 39.6 to 37% for individuals taxed at the highest rate, but it imposed this SALT cap of $10,000. And most high wage earners paid very significantly more in tax in 2018 and thereafter because the cap cost them more because they couldn't deduct their state and local taxes than they benefited from the rate reduction. So it was really quite a significant tax increase. Almost 900 billion over the 10-year budget window of tax increases from the cap. After that was enacted, a lot of states enacted workarounds. So if you operate through an S corp or a partnership, the states changed their law so that entity could pay the tax like a corporation pays the state tax, and then those credits could be passed through to individuals, and that wouldn't be subject to the cap. The IRS put out a notice that blessed that basically and said they were going to issue regulations, which they haven't done yet, but basically taxpayers can rely on that notice. And the IRS is now not going to issue any contrary regs to shut down the workarounds because Congress decided basically not to attack the workarounds. So what's the rule? Raises the cap from 10 to 40, but not for high wage earners. There's a phase out that starts for people who have modified adjusted income over $500,000. They start to lose the benefits of that increase until ultimately they're back down to the 10%, the $10,000 cap on SALT. So for the very highest wage earners, the bad news is, I guess, the cap really isn't raised for you. For people who are more in the middle, it is raised. And then for those who own interest through partnerships and S corps, you're safe, and the workarounds are there. People are doing examples and playing out various scenarios, but that's the cap at a high level. As I mentioned before, the federal legislation couldn't, because of the Byrd rule, go after the state laws that are trying to drag taxpayers in for merely having a website where state residents are placing orders and things like that. I'm hopeful that this will be bipartisan and that maybe Congress can get it done later in the year, this Public Law 86-272. Big news on qualified small business stock. The legislation amends 1202 in three very beneficial ways. First, the partial exclusion from the sale of qualified small business stock now starts after a 3-year holding period rather than 5 years, and there's a thing at 4 years. Second, the amount of eligible gain that can be excluded is increased from 10 million to 15 million. And then third, the definition of qualified small business stock is broadened to include businesses with gross assets of up to 75 rather than the old 50. We have seen some missteps in this space recently where a fund will raise money and get dollars in from essentially tax partners and then purchase. It doesn't work. They have to be partners at the time that the stock is purchased. So there's going to continue to be a lot of activity in this space. There's a lot of technical rules, and we've seen a number of foot faults and unwinds and all sorts of things, but great news at a high level for the 1202 and the qualified small business stock. Again, Peter, maybe comment on this as part of Trump saying, look, we want people investing here.
I think that is absolutely the story, and that there is a real desire to lower these barriers of entry and to make this easier and to be forthright about it. And so that's spoken to directly in this legislation.
Okay, we're going to pick up the pace a little bit to get to the individual provisions. 199A, it's made permanent at a 20%. They thought about increasing that deduction to 23, but that was really tied to a time when they were going to lower the corporate rate, or at least lower the corporate rate on manufacturing. When that didn't happen, they said, hey, this really should stay at 20. 461L makes permanent disallowance on non-corporate excess business losses. It's interesting. There was a version that said, look, if you have to carry that forward, it'll be treated the next year as a 461L excess business loss. And that was changed. And now if you carry it forward, it's treated as an NOL that's carried over to the succeeding year. Disguised sales of partnerships. Some thought there was some ambiguity about whether you needed regs to make the statute effective on disguised sales. That's been fixed with no inference on current law. TRS, taxable REIT subsidiaries. REITs are now going to be permitted after December 31st to have taxable REIT subsidiary stock 25% rather than 20% on the 75% asset value test of 836C4. Some good news for oil and gas intangible drilling. I'm going to skip some of these. Opportunity zones. The Opportunity Zone program becomes a permanent fixture of the code. It's great news. Beginning January 21st, 2027, there'll be a rolling 10-year Opportunity Zone designations. Every 10 years, census tracts will be reviewed to determine if they still qualify. State governors will have the opportunity to redesignate. I will say, so moving on to the low-income housing tax credit, again, it makes the following changes very helpful. It includes a permanent 12% increase to the annual 9% low-income housing tax allocation. It expands tax-exempt bond financing provisions. So under the current rules, if 50% or more of the aggregate basis of a building and land is financed with tax-exempt bonds that are subject to the state's volume cap, that entire building would be eligible for 4% credits without an allocation from the state. The legislation generally expands that favorable rule to buildings, at least 25% of the aggregate basis of which are financed with tax-exempt bonds. So you're going to see a lot of activity taking advantage of these low-income housing tax credit rules. New market tax credits, it wasn't part of the House bill, and we thought, what are they going to do? Let it sunset? No, there's great news. The legislation provides a permanent extension of the new markets tax credit program with $5 billion of allocations available to be awarded to the CDEs on an annual basis beginning in 2026. Information reporting on 1099K, the legislation reverts to the $20,000. The gross amount of transactions have to exceed $20,000 and the aggregate number has to exceed 200. There was a sort of a disaster waiting to happen with the old legislation and the IRS catching the dog, catching the bus and not wanting to do with it when they lowered these thresholds, but now they've put them back. They've increased certain 1099 and other reporting with respect to certain payees. They've raised the threshold from 600 to 2,000 with respect to payments made after December 31st, 2025. Employee retention tax credit. They made some technical changes. They extended the statute with respect to a couple of quarters where they could, because the claims, ERTC claims were against Medicare taxes. They couldn't do it for other quarters where Social Security taxes had been refunded. There's some modest increased penalties against promoters. The most egregious ones, at least the way I read the final bill, were taken out. Individual tax changes. Let's talk about some of this. Makes the individual tax rates permanent, the standard deduction permanent. There's some helpful inflation adjustments. We got an extra year of inflation adjustment, for example, in the 37% bracket and other brackets. It continues the elimination of personal exemptions by permanently setting the deduction amount at 0, but it does provide a temporary $6,000 deduction for seniors under Section 151. President Trump said he wasn't going to tax seniors on their Social Security income. He couldn't do that with the Byrd rule. So instead, they put this temporarily in place where seniors get a temporary deduction under Section 151, which is a personal exemption for 20 years, 2025 through 2028. It's subject to income limitations, 75,000 individual, 150 joint filers, but that's there to help them offset what tax they might also otherwise pay on Social Security. It permanently repeals miscellaneous itemized deductions, but restores deductions of unreimbursed educator expenses for teachers. It caps the value of itemized deductions at 35% and places a floor of 0.5% on itemized deductions for charitable contributions. So interestingly, there was a lot of push to let non-itemizers take some charitable deduction, which they gave. There's now an above the line deduction of $1,000 or $2,000 for joint filers for charity deductions for contributions to charities. But to pay for that, for itemizers, you don't get to deduct your charitable contributions until your deductions exceed 0.5% of your adjusted gross income. And then for corporations, you don't get to deduct for charity until it exceeds 1%. They basically paid to give some people a charitable contribution deduction by taking away the value on others. And they brought back this notion that all your itemized deductions, you're not going to get a 37% benefit. It's going to be 35%. So I would call these cheap shots, and maybe we can get rid of them going forward. It is what it is for now. I think you're going to see corporations, instead of donating to charity, they'll see about whether they can do a sponsorship, as long as they don't get caught up into capitalization as advertising and things like that. So there's going to be a lot of thinking about how to avoid some of these rules. Tax credit for children goes up by $200 to $2,200. It's permanent. It's effective for 2025. It's indexed for inflation. There's these new Trump investment accounts, which are fascinating. I don't think we're going to be able to talk about it at a detailed level, but I'm going to ask Peter to talk about just at a high level for a minute. It does eliminate tax on tips for years 2025 through 2028, capped at $25,000. It's a federal income tax deduction that the person who received the tips would take on their federal return. You know, you can only take up to 25, and it's phased out for those who earn more than 150, and it's a phase out for those who earn more than 300,000 for joint filers. There's all sorts of technical rules associated with it. It also eliminates the tax on overtime, and there's employer issues here. Again, only for tax years 25 through 28. Again, it's limited to a federal income tax deduction of $12,500 for people who get overtime, $25,000 for joint filers. There's phase outs for those earning more than 150, 300 joint. There's going to have to be some adjustments to employer reporting to explain what's overtime and what's not. There are car loan deduction interests associated with car loans if the car is assembled in the US, but again, there's a $10,000 limit. And then for those earning more than 100, 200,000 joint, can't take advantage of it. There are changes to the alternative minimum tax exemptions. There are makes permanent the Tax Cuts and Jobs Act limits regarding deductions of mortgage interest, basically $750,000 of acquisition debt, no deductions with home equity lines. There's a really funny one that's been getting a lot of attention on social media. It extends and modifies the limitations on wagering losses. It basically limits the definition of annual wagering loss to 90% of your actual loss, and then allows deductions of that only to the extent you have gains. So it's pretty punitive and not necessarily fair. Somebody dropped the ball there. I don't know if that will stick long-term or not, but it's in the code for now. There's a lot more on these individual changes. Thoughts about Trump accounts? Peter, we've got some details in here. It's really interesting, and there's some potential significant opportunities. There is a fee cap of 0.1% of the balance, which is interesting, but people might be able to use these to get introductions to families and then manage more of their money later. Treasury is going to contribute to these, and you can put in $5,000 basically a year yourself. But details aside, thoughts about Trump accounts?
I think it's fascinating. Just So this is a gesture to the president, obviously. It's a named legacy within the bill that's significant. And as we all know, he tends to be satisfied by these types of things. I also think my prediction is that they'll be fairly popular, that folks are going to use them and use them as a vehicle to get their kids off to a start as it relates to retirement. And the numbers start to make sense. I think a lot of the limitations that you pointed out will be fairly popular guardrails along the way. And I predict that in 10, 20, 30 years, these types of accounts are going to be expanded to be able to do more things. It'll be fascinating to watch the evolution of this.
Great. Estate and gift tax, good news here. The legislation permanently increases the estate and gift tax exemption to 15 million per individual, 30 million per couple for tax years 2026 and beyond, and it indexes it for inflation. Premium tax credit limitations, I'm going to just leave the slide to you. There is a new excise tax on remittance transfers, 1% excise tax to certain international remittances. A lot of details associated with this. There's a number of carve-outs. There is Social Security number requirements for lots of purposes. And for the child credits, both parents, I think, and the child have to have Social Security numbers. So there's credits for Social Security numbers required for a number of education credits and other things. We're not going to get to cover in detail the exempt organization changes, but there is an increase in the endowment tax under 4968, basically from 1.4% to 8% for certain institutions. There's also an expansion of the tax on excess compensation. This was very broad in one of the first drafts. It talked about large foundations and any related entity. And every law firm said, we're a related entity. We have a foundation. Every big company said, we're a related entity. We have a big foundation. Does that mean that every time we pay someone over $1 million, there's a UBIT tax on the foundation? A lot of that stuff was fixed, but the basic rule is still there in this. We talked about the modification on charitable contribution deductions, the above the line for those who don't itemize, and then the penalties on corporations and those who do itemize. There's really interesting employer provided benefits. There's changes to health savings accounts, which are very helpful. There's telehealth changes that retroactively reinstates exemptions when the original exemption expired and makes the exemption permanent. There's direct primary care service arrangements. Our clients have these, and there's beneficial changes there. There's effective dates. There's provisions on educational assistance provided by employers. There's dependent care flexible spending account contribution increases up to $7,500, up from $5,000. They're repealing the tax-free reimbursement for bicycle commuting expenses. There is an issue about employer provided meals. There's a question. So for amounts paid or incurred after December 31st, 2025, if you've got cafeteria in-house, you're going to have to pay attention to this. There was a Washington Post story that said that this applied to coffee, to snacks, and I think largely the tax bar disagrees with that, but there's going to be obviously some information and some guidance that we're going to need about this going forward. And then there's some miscellaneous items, sound recording, firearms, excise tax repeal. And I think with that, I would like to say that, look, there's going to be more reconciliation bills probably before the elections, the midterm elections. There's going to be bipartisan legislation. There's going to be the IRS implementing and looking for input from people about how they should implement these things. Peter, why don't you close just by explaining that notwithstanding the size of this and notwithstanding everything that's done, it's really an ongoing story.
Well, it is absolutely an ongoing story. And Jeff, listening to you as you were going through in detail, it's fascinating for me to trace, I know where that constituency drove 163J, for example, saving the DA, and some of these other things there was a broad constituency around some of these things that were corrections to TCJA. You also highlighted some things that were like, look, this is going to have to be dealt with in future versions of tax legislation. And then the Treasury Department is now all hands on deck. So it's a continuing story. And to understand each piece, is to be able to make predictions about what the next one's going to look like. So we're here to help and would be delighted to engage on any level. Thanks, Jeff, for the opportunity to be along with you on this ride.
Thanks, Peter, and thanks for your great work in getting all this done, especially your great work for our clients who had cared a lot about some of these provisions. But thanks so much for joining us today. We're grateful that you've taken the time, and we're here if you have additional questions. Thanks, everybody.
Thank you, Peter and Jeff. If you have any questions for Peter or Jeff, their contact information is in the show notes. As always, thanks for listening to Baker Hosts. Comments heard on Baker Hosts are for informational purposes and should not be construed as legal advice regarding any specific facts or circumstances. Listeners should not act upon the information provided on Baker Hosts without first consulting with a lawyer directly. The opinions expressed on Baker Hosts are those of participants appearing on the program and do not necessarily reflect those of the firm. For more information about our practices and experience, please visit bakerlaw.com.